right, have your teacher have been talking about depreciation, but you don't seem to understand what he or she is talking about? Well, if that is you, this video is for you. Today we'll be talking about depreciation, right? Theory and practice. My name is Serene Jackson, former CXC marker and lecturer, right? And so today I'll be looking at depreciation. All right, so let's get right into it. Please remember to like, subscribe, and share, right? And let's have fun. So depreciation. What is depreciation? So depreciation is basically the reduction in the value of a fixed asset over time. I want you to pay attention to the word fixed asset, because that is the only thing that depreciation affects, right? Fixed asset. So depreciation definitely speaks to our fixed asset that we have in the business, right? When the value of the fixed asset is reduced over time. Depreciation is also an expense to the business, and that is a very important piece of information that you will need, right? Especially when you're doing income statement, right? The profit and loss section of the income statement. Depreciation is an expense to the business. So then what causes depreciation, right? Well, as it states in the definition, when an asset gets old over time, the value goes down, right? That's one reason. The asset can be damaged, right? And that will bring down the value of the asset as well, right? When you have improvement in technology, right, that will make the asset obsolete or irrelevant, then the value of the asset will also go down, right? So the wear and tear of the asset over time, the asset getting damaged or improvements in technology, right, can make the asset obsolete or irrelevant, and that can cause the value of the asset to go down, which is what we call depreciation. Now, there are numerous ways, right, or methods of calculating depreciation in accounting. However, for the CXC syllabus or the CSEC syllabus, it only requires us to look at two methods. And so the two methods that we'll be looking at are the straight line method and the reducing balance method. So these are the two methods of calculating depreciation that we'll be looking at. So let's look at what the straight line method is. So the straight line method really is a method where the fixed amount, or where a fixed amount is deducted from the value of the asset each year. The amount never changes, right? But it remains constant, and that is why it is called the straight line method. Just like our line is constant, right, or linear, yeah, that is how the straight line method is. The amount remains constant over time, the amount for depreciation. Now, not all the time the value for depreciation will be given using the straight line method. And so if you don't know the value for depreciation under the straight line method, then you can calculate it using a formula, right? So the formula is really depreciation equal cost of the asset minus the selling price, or we can also call the selling price the residual value, or the scrap value, or the net book value, right? So those are various names for the selling price, right? And then all of that is divided now by the number of years. The number of years you hope to keep the asset, or the number of years you have kept the asset. All right, so that's really the formula, and the formula only relates to the straight line method, so please bear that in mind. All right, and then you have the reducing balance method, right? In this method, a fixed percentage is calculated on the cost of the asset in the first year, and in the first year only, right? In the years after the first year, the fixed percentage is calculated on the reduced balance. All right, so in this method, you pay more for the depreciation in the earlier years of the asset's life, right? And that is why it's called the reducing balance. So it reduces the balance of the asset over the time. All right, so let's practice. All right, so get your pencils, get your books and everything, get them out, and let's practice. All right, so here is a question that we have on our left. It's a very old question. It's from 2001. You will realize, however, that I have blurred out, right, the second part of the question, it is still on depreciation, but it is talking about the double entry for depreciation. Right now, double entry for depreciation has somehow been removed, right, from the syllabus, and so we won't get into that right now. However, depreciation is pretty much still there. So we're going to learn, we're going to practice, right, how to calculate depreciation using this first part of the question. All right. So this is my little workstation, my little thing that I drew up. Right now, there is no real way, there's no set way rather, on how to calculate a depreciation, but I like to do mine in a little table. It makes it easier, it organizes the information easier. All right, so even when you are practicing, you can use a little table too, just to organize the information. All right, now let's look at this question. It says the Talco Enterprise bought a machine costing $60,000. The estimated useful life of the machine is 8 years. The method of depreciation used in the first 4 years was the straight line method, after which the reducing balance method was applied at the rate of 20% per annum. Determine the depreciation expense to be charged to Talco's profit and loss account in the year in each of the 8 years of the machine's useful life, and give the residual value of the machine over the 8 years, right? So you realize that they use both methods, right? Remember that the first thing that you do when you are doing a question is to read through the question carefully, right? And the straight line method is the method that they said they use in the first year. And remember the depreciation formula. So depreciation would be equal to the cost minus the selling price divided by the number of years, right? So that's the formula that we'll be using. So depreciation then will be equal to the cost, right? What is the cost for this? So the cost, as we are given, is $60,000 minus the selling price, right? Were we given a selling price for the asset? No, we were not given a selling price, so we don't have anything. Let's write 0 right there, right? And then all of that is divided by the number of years, which is what? 8 years. Number of years, which is 8 years. So we continue using our formula. So it is 60,000. So you pull out a calculator. You have 60,000 divided by 8 would be equal to $7,500. $7,500 is the amount there, right? Because that is the amount of years that we hope to keep the asset for, $7,500. Therefore, the depreciation figure that we will be using is $7,500. So let's look at the cost now. Let's put in the information here. The cost of the asset is $60,000. The year one depreciation, we have just calculated it. It is $7,500, right? So 7,500 60,000 minus 7,500 will be equal to 52,500. So that is 52,500, right? All right. So year two, the value for depreciation would still be 7,500, right? Because the straight line method, you don't change the amount for depreciation. So the value for depreciation in year two is the same 7,500, right? So for 52,500 minus 7,500, that leaves us with $45,000. $45,000. In year three, the value for depreciation is how much? You guessed it, 7,500. Right, the value for depreciation does not change. It doesn't change one bit. And that's the good thing about the straight line method. It's very easy. Students normally like the straight line method because it is pretty straightforward. Get it? All right. So 45,000 minus 7,500 equal 37,500. 37,500. And in year 4, the value for depreciation is how much? You guessed it, 7,500. So 7,500, right? 37,500 minus 7,500 would leave us with $30,000, right? So at the end of the 4 years, the asset valued $30,000. All right. But the question did say the first 4 years is the straight line method. The second 4 years is the reducing balance method. So let's look at the reducing balance method now. Remember that in the reducing balance method, right? The reducing balance method, it states that a fixed percentage is charged, which is 20%. So 20% of the cost of the item in the first year. Now, the first year that we're using this reducing balance method, the cost of the item was what? $30,000. That would have been what we would term as the cost of the item, because that is the value of the item, right? So it's 20% of $30,000. 20% of $30,000, let's calculate that. It's supposed to be 6,000, but let's calculate it, right? So 20 divided by 100 multiplied by 30,000 is $6,000, right? So $6,000, that is the amount, $6,000 in year 1. So we subtract the 6,000 from the 36,000, from the 30,000 rather, right? And that should leave us with what? $24,000. In year 2, the value for depreciation is 20% off, and this is where it is a little bit different now with the reducing balance method. 20% off, instead of you saying 30,000, you would say now $24,000. And the reason why that is because 24,000 is the reduced balance, right? And so now you pull out a calculator, you say 20 divided by 100 multiply by 24,000, that would be equal to $4,800, right? So you subtract that, right? So 24,000 minus 4,800 will be equal to 19,200. 19,200, right? And so in year 3, right? Year 3, they said 8 years, so it is 4 years each. So in year 3, right? Or you could say year 7 if you want, whichever way. So it's 20% of the reduced balance, which is 19,200, right? So you pull out the calculator again, right? You say 19,000, right? Say 20 divided by 100 multiply by 19,200. That is equal to 3,840. So that's the depreciation value, 3,840. All right, so you're going to subtract that. So 3,840, 19,200. That leaves us with 15,360. 15,360. And then in the final year, year 4 or year 8, depending on how you want to write it, right? So it's 20% of 15,360. Right? So 15,360 multiplied by 0.2, because that is 20%, right? Equal to $3,072. $3,072. Right? And you subtract that now from 15,360, and you get $12,288. $12,288. This you can double line, because this is what we would call now your net book value. Net book value, right? So then, after 8 years, using both methods to calculate depreciation on this asset, the the residual value, right, of the machine, right, after 8 years, the residual value after 8 years would be $12,288. I hope you saw the difference in calculation between the straight line method and the reducing balance method. All right. So let me know what you want me to do next in the comment section. Let me know if this was clear enough. Let me know if you understand. Let me know what you think. Right. Remember to like, subscribe, and share with your friends. All right. And I will see you in the next video. All right. Well, good.